Welcome to Show Me the Edge, and today we're talking about stochastics. Although I'm a registered investment advisor, I'm not your advisor, so consider the risks carefully and seek advice from a professional who understands your unique circumstances. So today we're going to answer the question, does the stochastic indicator give traders an edge in the markets? And really the first question to know how to answer that is, how do we even use the stochastics? Do we use it to buy low, sell high, sell higher, buy the cross above the low, and all of these other ideas? And really, it can be quite overwhelming when you look at an indicator and just trying to figure out, what am I supposed to do with this? Is the way that I see it the way I'm supposed to use it? Am I supposed to change anything? And all of that. So a little spoiler alert, I'm going to give you a sneak peek at some of the results that you're going to see today. And it really is quite promising. So I think you're going to enjoy that. A quick intro. My name is Andrew Faldy. I have 15 years of experience in developing systems and trading for firms and investors. So as always, even though we see beautiful results, we aim for evidence of a robust and reliable system, not just the best hypothetical returns that come from overfitting past data. All right. That's why we look at many different ways to trade it, and we focus on stress testing, not just optimizing. So we ultimately know how hard it is to break. And just like Drago said to Rocky Balboa in Rocky IV, I must break you. Our goal is actually to try to break the strategy, break the indicator, show how sensitive it is and how unreliable it might be, not just pull up one random set of data that says, wow, look at that great result, let's run with it. So that's the approach we're going to take. And if it's ultimately profitable and it's hard to break, then we can incubate live, scale into production using fully automated trading systems. So here's the first idea, is the buy low, sell high. Very common approach to using this indicator. And the rules will simply be, if the fast K, which is the blue line you'll see on the chart, is below 20, then we're going to buy at the open of the next bar. If it gets above 80, then we're going to sell the open of the next bar. And just for reference, we're using the standard settings as shown below. So the indicator would look kind of like this. When the blue line gets below that 20 level at the bottom, that's our buy signal. When it gets above, then we're going to sell. And just to make sure that we're not just only checking one market or using bias on things that we like or things that have gone up a lot, we pulled a random list from ChatGPT, and that is what we're doing. And we'll paste our list of symbols right here, connect them up, and through the power of automated backtesting, we can see every single time that the signal occurred. So this is the top one here is SPY, and just a quick visual check. You can see the blue line gets below the green line, the 20 level, so it buys the open of the next bar, and when the blue line gets back above, it sells the open of the next bar. And we have that symbol, and we have all of these times that that's happened over many, many, many years. And you can see it would be very hard to determine just by looking at it whether or not this indicator is any good. But with automated backtesting, we can get the report right now. So this is the equity curve, the returns over the number of trades that have happened over that period of time on SPY. And we're just going to click through these real quick and just get a sense of how well this specific version works, or at least how consistently it works. So here's Apple. I'm just going to click on through. Microsoft, Coke. I'm just going to slide this over so we can see them. Pepsi, that's really good. J&J, all the settings are the same here. This is default too. Default settings on the indicator. Johnson & Johnson, Procter. Okay. Takes a second to load, but just look at the hundreds of trades and the decades that are going by and the data coming back. This is really Okay, there's one. We finally got a loser, but that was a really strong series there of returns. Quite surprising for a default indicator. Unbelievable. Like McDonald's, Disney. It just keeps on going. All right. I mean, we got one loser and some amazing ones and some really solid ones. Yeah, overall, these are slower moving stocks, so the absolute returns aren't phenomenal, but the consistency is pretty good. And then we'll just finish clicking through the rest of these. So in general, better than I expected. I expected a lot more like this. I expected a few more losers, and I expected a lot of ones that barely ended up profitable or break even or just had a bunch of ups and a bunch of downs. But overall, pretty surprised at how consistent that is. All right, so here's a quick analysis of idea number one. It struggles in strong bear markets and crashes. It doesn't really have good risk controls because it can hang on to losers for a long time. So just because price that gets below or the indicator gets below 20 doesn't mean it has to turn back up. It can get below 20 and stay there for a very long time and for a very long ride down. So overall, it does show signs that there is an edge available, but it does need some work to control the risks better. So let's try idea number two, which is to wait for the turn. And that means instead of when the indicator gets below 20, we're going to actually wait for it to be below 20, but cross back above that 20 level. And everything else will remain the same. The best way to test things, I found, is to just make one change at a time. So we're going to make this one change to the strategy, see the impact it makes. If we make two changes, then we don't know which change made the biggest. All right, now we're on to idea number two, which is to wait for the turn. And right here we see the previous version. If the fast line, the blue line, got below the green, it would buy the next bar, which would have been there, but it didn't buy because it waited for the turn back above, and then it buys the open of the next bar. And then when it crosses above the 80, it will close that. So that's the next idea. So now, same thing. We got all the history of that on a little basket of randomly generated symbols. So let's just check out these results by clicking through. Okay. That is worse, I believe, than the original. I think the original was better on that one. I don't remember that one. That's good. Keep in mind, as we click through, you can see the results. I don't have to give too much commentary on that, but other important ideas is our focus is I want to see problems. I don't ignore them. I want to see them. I want to see how many variations and ways can I use this and expect a result, a positive result in the long term. Is this one that did poorly before? There was one that had a loss. It might have been that one. That's solid. Very similar results. In general, it's possibly a little choppier. But I'm looking for, hey, you know, if you do it when it crosses below or it crosses above, either way from down low to up high, a bunch of different markets. That one also works. Okay. Now I'm not adding up, you know, in the future, maybe even in this video, we'll see. I'm going to check at the portfolio level and get a single result for the entire portfolio and compare them. But for now, just this quick view shows a little choppier, I think, but still a positive edge across there with only one losing one, some volatility. So in general, not as attractive, but still effective. All right, here's analysis of idea number two. Not as good. It really isn't as good. Ultimately, in looking at the results, looking at the trades, what we see is the winners are smaller because we're buying at a higher level many of the times. And I'm sorry, I said that wrong. The winners are smaller because, yeah, we're buying at a higher level, which means we have less room to the upside, so we're going to have smaller wins. And then the losers are bigger because on that uptick and we buy, there's more downside because if the price turns back down, the indicator goes back below 20, you stick with the position. So that's not very good. And it can hold those big losses if price resumes a bear trend. So let's try another type of risk control, which is going to be idea number 3, a bear trend filter. And we're going to go back to, so this change, our changes here are bold and underlined, and this one's in italics because we're showing we're going back to just below the 20. So it's below the 20, but our risk improvement that we're going to try to add here is, but the price is above the 200-day average, which is a good filter for bear trends.
All right, first we're going to put the 200 average on here. Just hit that. Okay, and now we're going to be able to see that there are no trades when we are under. So it took an exit on that one, but there's no new entries. Okay, so that's one I'm looking for. Yeah, so here, it's selling off below the 200 moving average. Doesn't take that entry. Could have had a win, maybe, because, yeah, would have had a small win there. But here, you can see that gets below and really just sells off hard, right? So the goal here is reduce some of our downside risk by not buying dips when the market's down a lot like this. Okay, no trades in here. All of these trades are ignored. So that can make a substantial difference in the results, all right? So we're going to pull up the report and go through these. So here's SPY, very smooth. Apple, not quite as good, I don't think, as before. Microsoft looks a little better. Coke, good. Good. Fine. All right. Also, you notice there's fewer trades. These, before it was over 200 trades. Now we have fewer because we're skipping all those trades. That's very solid here. So fewer trades because we're staying out of those very risky times. This is great. All right. I think IBM's one that struggled before. Definitely loses a lot less on that round. Solid. Okay. I think that was one that struggled a little bit before too. It's good, good, good. All right. Yeah. I like this. I really like adding that 200 filter. That's one, even by itself. That's a very simple feature. You know, on its own you could use, but combined with other things, beneficial to use that 200 moving average to filter out bear markets. Very good. Good. This is one, if you recall, some versions go spike up a lot and then spikes way back down. So holds up a little bit better there. Our last one here, very, very solid. Okay, so that's excellent. All right. So that was idea number 3 with the 200 moving average filter.
All right, here's a quick analysis of idea number 3. It does have better risk control with the filter and still seeks small returns relative to potential risk. What does that mean? It means that just going back to the 80 level, so those trades that rise back up, the indicator goes back to 80, we're trying to capture relatively small gains compared to the type of risk that you hold, because there really isn't a stop loss or an exit on this system. And that really is going to be a reason why it can never be traded at a very, very large size, for sure. But we're going to try to improve this further by sticking with the signal, okay? So idea number 4 is we're going to try to improve the risk reward, okay? One way is to reduce the risk, but we're going to actually just try to improve the reward first. So everything's going to stay the same on the entry. That is, we're below the 20. The price is above the 200-day average. But we're going to wait on the exit for a cross back below the 80 level. All right, so it can rise up above and then catch a long trend.
All right, with number 4 now, we have the goal of holding winners longer. So
all right, here's our quick analysis for idea number 4. A losing symbol turned into a winner, and many of the winning symbols made more, maybe all of them, but I think just the vast majority. So this was a major improvement by improving the risk and return profile, meaning we're trying to get more reward for the amount of risk that we're taking. So that really improved things. So another technique we take from here, because we've had one list of stocks and we're kind of moving through this kind of an optimization process here. So what I like to do is just immediately jump out and try something totally different, a different list of stocks, etc., and see what kind of results we get. So we're going to check some other markets. So we're going to do the NASDAQ 100 holdings. We're going to use 40 years of data. We're going to take idea number 4, which is the buy low, hold winners, and have a bear market filter. And I did add a $2 minimum price just so any back adjusted data, we don't have any penny stock or bad data just from split adjustments, which really makes some messy data. So it just cleans things up a lot. And here is the portfolio level result trading 100 stocks on idea number 4. And this is all just using the default settings. We've barely touched this. We just have a simple reason to buy, a different type of reason to exit where we can hold the winners before that exit on the upside. But we've done no real optimization. We've not changed any of the settings of the indicator. We've not tried hourly bars. We've not tried very many things at all. This is just the basic starting point. And we have no compounding of the gains. So if you were to compound the results, which is really good for showing the type of risk you take long term, the results get really exciting. So, and that's, by the way, how we got this, when that sneak peek from earlier, that's how we got that, is that strategy with compounding on there. So what's next? We can optimize the standard settings. So we can go through and say, is 14, 3, 3, and 1 the best? Is 80 and 20, are those the best levels? So there's so much we can do. We can try other time intervals. So we've done daily, but what about weekly and hourly and half hour and minute bars? Okay. And what about short entries? What about when we're below the 200, instead of buying and selling, what if we short and cover? So there's a lot of opportunity there as well. And we've not touched dynamic sizing. Every single stock got the same amount of dollars put behind it, regardless of the amount of volatility or risk that was involved. So dynamic sizing, like volatility adjusted sizing, can improve results in consistency and smoothness even more. All right, but that's more than we can get into right now. But if you would love to learn more about this type of analysis, these types of strategies to give yourself an edge, I ask you, are you ready to dive deeper with us? So if you are, join us at edgenavigator.com. And over there, you can find all the opportunities to learn more about strategies like this. In our members area, we're going to dive more into stochastics and other types of systems and strategies, and you can learn about those and apply them for yourself, learn about algos, learn about automation, learn about options trades, on signals, and all types of things like that. So join us right now over at edgenavigator.com.